Hello and welcome to the ISE ETF and Index Outlook for July 2nd, 2012. This is Patrick Sresna. As always, we start off with the chart of the S&P 500 using that SPDR exchange traded fund symbol SPY. Last week we were looking for follow-through selling based upon the reversal candles and anticipating new further weakness, but with the Euro summit having had a very positive result, it created a short squeeze on the upside that substantially strengthened the Euro and the S&P 500. At this juncture, with this type of reversal, it neutralizes the sell signal we were observing last week and really opens the window for even further consolidation for even the next couple of weeks. Now, even in the most optimistic case scenario, where we would see a rally that could make it all the way back to the previous highs around the 141, 142, but that doesn't necessarily have to happen. There is the potential for rallies up to the 137, 138 level on the upside. A lot of more choppy sideways price action with a lot of consolidation that then maybe in the middle of July would subsequently reverse, particularly with this week being split up with the 4th of July holiday. It would make it a relatively lower volume trading week going into the jobs numbers on Friday. Next here I want to take a look at the ISE Global Copper Index, which is the symbol ISC, and here we saw a nice bottoming formation right around the 280 to 300 focal point on the downside, and subsequently that basing has now come up with a big reversal candle based upon the strength we're seeing in the broader markets. If this has banged out a short-term bottom, it is likely that we're going to see a rally that could not only make it back to the 320 highs, but we could see a full retracement that could even temporarily see it trade up to the 340, even 350 areas on the upside. While in the bigger picture we're not necessarily bullish the copper index for the remainder of the year, there certainly is plenty of room for it to retrace some of that extremely oversold market that it's been in the last 4 months. So we'll continue to observe whether or not there's follow through on Friday's strength. Next year I want to take a look at the ISE Chindia Index, which is a symbol ICK, and what we saw here was a similar formation of the round of selling that came in last week, very quickly reversing to the upside without it even retesting the lows that it put in at the end of May. At this stage, this index is quite oversold, and it appears to be poised to continue to retrace. We're open to the idea that we could see strength even as high as $50, but more likely strength up to 47, 48, 49 as it continues to develop a retracing wedge off that extremely oversold state. At some point, maybe late July and going into August, and more than likely will sell again. But for now, at least for the next week or two, we may see now some further follow through and testing of some upper overhead resistance levels. Finally, I want to take a look at the ISE Natural Gas Index, which is the symbol FUM, and here again we saw another basing formation, a retest of the previous lows around that 85, 87 lows, and subsequently nice reversal in the last 3 days on the upside, which has taken the natural gas out of that sideways trade range it's been in almost 2 months. Really at this stage, we don't necessarily know how much more upside there is on this natural gas index on the short term, but it certainly has put an end to the existing downtrend. With this uptick, we could again see some retesting of some upper zones, maybe up in the 105 level on the upside in the upcoming week or two, and we'd want to see what kind of basing it does after the rally before we would take on any more bullish stance on this. At this stage, with the other indices we're talking about probably have some better short-term upside potential, but we are definitely going to be watching what kind of follow through this natural gas index has on the strength it had over the last 3 trading sessions. That was your ISE ETF and Index Outlook. Thank you for joining me.